Hey guys, thanks for clicking on my video. I'm going to teach you today how to pick funds in your 401k. I work for a firm that manages money. We manage around $500 million in assets, and part of my role is helping my clients decide how to invest money in their 401k. I allocate their funds in their 401k. So let's dive in and get started. As I walk through this video, I'm assuming you understand a few basic principles of investing. One, I'm assuming you understand risk and how that affects your portfolio, whether it be losses or gains over a long period of time. I'm also going to assume you understand the difference between a stock and a bond, the difference between actively managed funds, index funds, that you also understand the difference between domestic funds and international funds. The first graphic I want to show you is one by Vanguard, and it looks through bond indices and stock indices back through 1926 up through 2013. All the way to the left is 100% in bonds, all the way to the right is 100% in stocks. And there's incremental 10% shifts of the portfolio. Right in the middle is 50-50. If you look all the way on the left-hand side, what you'll notice is the average return is 5.5%. All the way to the right for the stock portfolio, the average return is 10.2%. The other thing that's really interesting in this illustration is down below it shows you the worst 1 year period. The worst 1 year period for an all bond portfolio would have been down 9.1%. All the way to the right, the worst 1 year period for an all stock portfolio would have been down 43.1%. By combining both stocks and bonds in your portfolio, you're going to lower the volatility. You'll provide some opportunities when, if stocks are down, you can sell your bonds, rebalance your portfolio, buy more equities that are down with the intention that when the stock market recovers, you're going to make more money. If you have a long time horizon, you may be willing to invest all of your money in stocks, understanding that if your portfolio suffers a major loss, you have plenty of time to recover those losses. What I want you to do, because interest rates have been very low and we're in this low return environment, whatever percentage return you see on the average, I want you to take 2% off of that. So for example, if you have an all bond portfolio, you could probably expect to receive over the next 10, 15, 20 years a 5.5. Historically, we'll bump that down to 3.5. I know it's low, but it's a little bit more realistic. So look at the illustration, kind of find what area or level you'd be comfortable with. So example, $100,000 in an all stock portfolio, worst 1 year is down 43%. Your $100,000 turns into less than $60,000. If that's a loss that you can't stomach to see, or you're worried that you may want to sell everything and move to cash or fixed income, you should not be invested that aggressively. So find an area with the combination of return expectation that you have, as well as what you're willing to stomach loss-wise. For this illustration, I'm going to start with a 70-30 portfolio. Not fully aggressive. There's some bonds in there for a cushion, but not too conservative either. This is probably a good allocation for somebody who's maybe 15, 20 years out from retirement. If you're 30, 40 years out from retirement and you can withstand those losses and not hit the panic button, you may be able to go 100% in equities. The first thing I do when I'm allocating my clients' portfolios is figure out that allocation. Now that we have that down, the 70-30, I split my equities up from my fixed income. Within your retirement plan, you're likely going to have limited options to pick from. You're going to have a handful of equity funds and a handful of fixed income funds. We like to allocate that equity portion between both US and international stocks. So we're going to take that 70% and we're going to take another 30% of that and move it into international funds. We're going to then take that 30% and take 1/3 of it and move it into emerging markets if you have an emerging market fund. If you do not, we're going to leave that all into international. The reason you want some international exposure is there's a lot of drivers of return in markets, and there may be a period where international performs better. So for easy math, in this portfolio, we have 70% stocks, 30% fixed income. That 70%, we're going to split it out and assign 20% to international. We're going to assign 10% to emerging markets if you have an emerging market fund in your portfolio. If not, leave it all international. Within the US portion, I personally like to allocate to some small or mid cap. So I want you to look at your offerings to see if you have any funds that have either small or mid cap in their name. So with your 70%, I would say 10% of your total portfolio could be allocated to small cap and 10% of your total portfolio to mid cap. So you have 70% in equities, 30% of that is going to international. That leaves us with 40. That 40%, we now are allocating 10% to small cap, 10% to mid cap, and that's going to leave us with 20% that we can invest in large cap equities, or a good offering might be the S&P 500 if you have indexed options, or a Vanguard large cap index fund. I personally like to stay away from active managed funds within the US equity space because of those added level of fees generally do not convert the fund to have higher performance over a long period of time. It's difficult for those active managers to outperform the standard indexes that they are trying to outperform. Your fixed income portfolio is going to be very driven by two things, either changes in interest rates or risk off periods. So if you have a stable value fund in your portfolio and the returns are 2-3%, and you feel interest rates are going to continue to rise, I like to put a large portion of my fixed income in that stable value. On the contrary, if interest rates are relatively high, if the 10-year treasury is around 3.5%, 4%, 5%, I would rather see your portfolio be allocated to a bond fund, a core bond fund, or there may be some type of index fund that follows the Barclays aggregate. So the 30% of the fixed income is going to be a little bit more easily allocated. You may only be using one fund. If you have treasury funds, they are a very highly sensitive investment to interest rate changes, but they also provide a lot of downside protection if the market were to go into recession and there are massive sell-offs. Treasuries generally move very quickly in a positive direction and help prop up your portfolio. So if you don't have treasuries, if you don't have any international fixed income positions, allocate that full 30% to either a core bond portfolio that's actively managed, a stable value second, or third, an index base fund like that follows maybe the Barclays aggregate. The most important thing that you need to follow when you're investing is develop a plan and stick to it. Know what risk you're willing to take before you build a portfolio. Understand your risk. And if things start going poorly, focus on your time horizon, not the investment loss. If your portfolio is down 10%, if it's down 20%, if it's down 30%, the worst thing you can do is hit the exit button and sell everything. If you look over time, there are significant drawdowns in the markets. If you sell at the bottom and move to cash, move to fixed income, that's one of the most detrimental things you can do to your portfolio. If you can't stomach the risk, start off more conservative and try not to chase returns. If the market does really well, don't all of a sudden get really aggressive because you feel the market's going to keep going up forever. Understand your risk, be willing to suffer losses, hold for the long term, don't sell, hit the exit button Don't be emotional. Stay invested and keep adding to your account. Take advantage of your match as much as you can and invest for the long haul. If this video was helpful, I want you to do a couple things. First, subscribe. That'll help me build my base and motivate me to do more videos. Second, hit the like button. Share the video, Facebook, friends, whatever, via email. And thirdly, if you have topics or questions, leave a comment. I'll do my best to respond. If I can't respond and I get enough comments for various topics, I will do more videos in the future and cover additional topics. I have a lot of ideas, different videos I'd like to do, but I want to do what is most important to you and what you have most questions about right now. Thanks for watching and have a great day.